Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. Twitter CEO Parag Agrawal lashes out at the company's former head of security, saying his false claims are riddled with inconsistencies and inaccuracies and presented without important context. Agrawal also said, and I quote, "This is frustrating and confusing to read, given the whistleblower was accountable for many aspects of this work that he's now inaccurately portraying more than 6 months after his termination." End of quote.
BrightChamps acquires a live learning platform for kids, Skola, in a $15 million cash and stock deal. The edtech firm had earmarked $100 million for making acquisitions across the US, UK, MENA, SEA and India in FY23.
Certify, a global product lifecycle management platform, bagged $65 million as part of its ongoing Series D funding round led by Singularity Growth Opportunity Fund. The funds will be used to further grow the business in international markets and strengthen the technology platform.
Artificial intelligence-backed sales pipeline readiness company RevSure raises seed funding of $3.5 million, led by innovation endeavors with participation from a host of angel investors. RevSure's sales pipeline solution will be launched and made available in September this year.
ED has allegedly found proceeds of crime of over 800 crore rupees as part of a long-drawn money laundering probe against 365 fintechs and their NBFC partners, as per a report. Loans of over 4,000 crores were disbursed by these fintech firms, which then sought to recover the amounts lent through telecallers, the report added.
Google has breached a European Union court ruling by sending unsolicited advertising emails directly to the inbox of Gmail users. Austrian advocacy group NOYB EU said in a complaint filed with France's data protection watchdog, the Alphabet unit should ask Gmail users for their prior consent before sending them any direct marketing emails, NOYB EU added.
Well, those are the headlines we are tracking for you this evening. Global product lifecycle management platform Certify secures $65 million as part of its ongoing Series D funding round led by Singularity Growth Opportunity Fund. In addition, several strategic investors like AmTrust, family offices like that of Pidilite, and existing investors including Iron Pillar, BNext, Bloom Ventures and DMI Sparkle Fund participated in the round. To talk about the road ahead at Certify, joining me now is its founder Srivatsa Prabhakar. Srivatsa, welcome back to Startup Street. If you could take me through the fund allocation plans you plan to further grow the business in international markets and, of course, strengthen the technology platform. So what new offerings are in the pipeline that support brands and consumers during this product usage, be it damage protection, extended warranty or trade-in and upgrade?
Thanks, Shruti. Good to be back here. Obviously, I think what we are trying to do with the latest funding is obviously getting into new markets. Because some of our partner brands, they want us to get into new markets like LATAM, Japan, etc. So obviously, some part of the funding will go there in establishing businesses, because when we start a new business in a new market, almost for 12 to 15 months, we can't make revenues because we need to get the compliances, get all the integrations, etc. So making our product ready for the market. So I think we will use some of them for international expansion. Obviously, also from a technology evolution, we want to really get into a space something called as Certify Care, which is in the works for a while, where currently as a consumer you are buying a plan for your TV, your phone separately, your laptop separately, and it could be of different brands. We want to get an umbrella program which we actually launched about a few weeks ago in the US already with one of the internet service providers. But we want to invest in really getting that umbrella program called Certify Care, which can encompass a Samsung Care and an Apple Care and an LG Care together. So as a consumer, you have one single touch point, irrespective of the number of gadgets or products you have at home.
Okay.
But you have one single window. So that's where we will invest a little more money. And obviously, the rest will be to build new capabilities like the buy now, pay later aggregation, or also some money for hopefully no more COVID-like situation, but we want to be well capitalized,
yes,
if at all there is ever a situation like that. So
absolutely,
that's the product allocation.
Okay, in fact, recently Certify extended its platform to enable affordable product purchases such as no-cost EMI, instant discounts, and I believe you're also looking to scale this offering with the raised capital. Give us a sense of the opportunity here.
Sure. So if you look at just India as a market, about $70 billion of electronics is sold. So I'm just talking about electronics and India as a region. Out of that, approximately about 22 to 24% of the products are sold on sponsored affordability, which means no cost EMI, instant discount, cashback, all of these offers, which are sponsored by either the brand or by the retailer or by the banks. So our belief is that large opportunity is still paper process driven or no consistent experience for the consumer. Think of it, if you walk into a outlet like a Chroma, you have an option to go to lender 1 if the process is not approved or you're not eligible, then you go to a lender 2, lender 3, lender 4. Or if you are a card user, you go to one terminal and probably eligibility checks happen on another terminal. So our belief is to get all of them under one common unified platform for a consumer, because we are already present in those outlets with our after-sales services, which is device protection and exchange offering. And it's anyway sponsored by the OEM or by the retail. Why not bring all of them under one unified capability and also bring that digital experience for the consumer? And that's what we are trying. So as we speak, we are running a pilot in about 190 to 194 odd stores across different markets, learning a lot. Obviously, not that we are doing the best probably yet, because it's still a pilot. But I think the idea is to run similar pilots in different markets, different product categories for another 3-4 months, and then scale it further. Obviously, we want to build a lot of capabilities in terms of unifying customer journey, getting the access to a larger credit base. For example, unfortunately, all of this sponsor affordability is yet targeted at probably 15 million credit card customers, or at best 350 million PAN card users. But in India, you have 1.3 billion people, about billion people who do not have a credit card or a PAN card. Are you saying they are not creditworthy or frauds? No, they're not. You need to find ways and means to include them. So I think our endeavor is to really bring that inclusion and work looking at consumer first rather than risk first approach. So I think that's exactly what we will launch. Obviously, it's still in the works, and I can't talk too much in public domain. That's our endeavor.
All right, lots of pilots in the works. Srivatsa, you currently have an annual revenue run rate of over $130 million. How soon are you looking to turn profitable? Also, if you could take me through the revenue model.
Sure. So, like I said, as of now, we have two business models. One is the warranty, extended warranty and damage protection. Second is the exchange and upgrade offering. First is a complete end-to-end experience that we manage, where we accept the GMV, we sell our services to an OEM who then bundles it as their service to consumer. So our model is almost like, you can think of this in the hardware world, maybe we are the Foxconn for an Apple, right? So or a Samsung. So our services are then bundled by the OEM, sold to the retail channel, and retailer sells to the consumer. So that's one offering. Second, exchange is more of a fee business. Again, we have a platform, we have a bidding platform, we have liquidators hooking onto our platform. So the price is discovered real time, and diagnostics and all those capabilities we have built with deep integration with the OEM. We are able to get both age and health of the product accurate, which then helps to determine the right price, and whoever bids the best price, that's passed on to the consumer, and we charge a fee for that transaction. So that's our fee business. And obviously with the affordability, again, it's going to be a fee business. So overall, as we speak, out of the $130 million, predominantly about 85 to 90%, 88% probably comes from the warranty business, and rest from the exchange and upgrade. But again, that's as we speak. We expect this year to close with about $150 plus million of revenue. And in terms of profitability, we are actually profitable in different geographies individually, but at a global basis at company level, we'll be profitable hopefully from October, November onwards. I mean, as of now, the numbers that we are seeing, we may actually turn profitable next month itself, but as per budget, it's still November, December.
Well, Srivatsa,
this month has been one of our best months in the history again. Almost touching 100 crores.
Srivatsa, that's really good to hear, but we've completely run out of time. Wish you the very best with all your future plans and growth plans. Many thanks for joining us on the show today.
So much. Have a good day. Bye-bye. Thanks for hosting me. Bye-bye.
And from one fundraise to another, fast-growing digital platforms for sexual wellness, women's wellness, and mental wellness, MojoCare recently raised $20.6 million in a Series A round. The startup, which was founded in 2021 by Ashwin Swaminathan and Rajat Gupta, has seen 60 times growth in its user base since its launch. Joining us today on the show is Ashwin Swaminathan, the co-founder of MojoCare, to elaborate on the company's expansion plan and growth outlook. Thank you so much for joining us on the show. Like I said, you're a digital platform for sexual wellness, women's wellness, mental wellness, and hair loss. Can you take us through how you provide a personalized care delivery system and assist users across in managing chronic and lifestyle-driven illnesses?
Absolutely. So thanks, Arundhati. Thanks, Shruti, for having me on the show. Firstly, what's important to understand with respect to specialty wellness is that these are problems that affect people in very different ways. These are multivariate problems. Two people having the same premature ejaculation issue could manifest it in very different ways. And there is a personalized care delivery system which we have designed in order to offer the best outcomes for each and every user. On the solution side, right, we have a combination of consultation and therapy. We have awareness creation about the right kind of diet and lifestyle, access to authentic medications to treat these conditions. Because if you look at it today, more than 70% of medications in specialty wellness available in the Indian market is counterfeit. And most importantly, in order to unlock such a latent market, handholding and a distribution first approach is required to treat the problems in a holistic manner. So this is how we define the MojoCare model as a full stack, personalized and a user-centric clinic. And we provide all of the above in a format that is very easy for the user to consume and control every single aspect of the experience,
Absolutely.
thereby delivering better outcomes.
And we're going to discuss each of your products and services in detail in a bit. But let's talk about the fundraise. You've raised $20.6 million. What's the fund allocation plan? Where's the money going?
So see, while we've raised a decently large round, the goal is not to splurge it. We do not believe in a high burn blitz scale model. And the reason why we are taking a distribution first approach is not only to unlock the latent market, but also to kind of build an enduring company that has a sustainable economic engine, right? And while your top line grows exponentially, the bottom line won't be in the red eternally. So the biggest avenues of investment for us will be building a rockstar team across the org: product, tech, marketing, clinical ops, user experience, logistics, new product development, etc. And while we talk a lot about going digital first and distribution first, the mobile app is a great unifier of GTMs in providing a care experience that is unified across all the different channels that we have. And it will take a few $1 million and a few quarters to get that user experience right before accelerating the pedal on top of the funnel. So that's what the funding deployment plan is going to look like.
All right. Why don't you take us, you've told us a little bit about your products and services. Take us through that. Take us through what you have in the pipeline as well. Anything new you're looking at?
So not really, right? We've picked certain spaces and we want to remain focused on specialty wellness, men's sexual wellness, women's wellness and fertility, mental wellness, hair and skin care, obesity management. These are problems that are plaguing 500 million Indians today and 750 to 800 million people across Southeast Asia and India. And, the user experience is extremely chaotic. So for us, from awareness to access, discovery to care delivery and digital monitoring, the goal is to provide a full stack user-centric care delivery system to every Indian and then go global. The focus will be very strictly on specialty wellness.
Right, so the focus is on specialty wellness. Now, within 12 months of your launch, you claim to have registered 45 times growth in your paid subscriber base and delivered care to users across 50% of India's PIN codes. So what's the current subscriber base and what percentage of these are paid subscribers?
See, this distribution-first approach does not mean that we have a ton of users on the top of the funnel whom we are not able to monetize, right? We have credible clinical content, we have free consultation and access to experts and proprietary distribution channels. And all of these, because of the nature of the experience and the trust that we've managed to create, has double-digit conversion and hundreds of thousands of paid active users. Today, we are doing about 3,000 free consultations a day, and double-digit percentage of those users are converting into paid subscribers.
All right. And you're present across a whole host of verticals, like you said. So with both products and services, so where are you seeing the most amount of traction? What's the best performing vertical for you?
Sexual wellness, without a doubt. The market is so deep and latent, and that's what the fulcrum positioning of the business is going to be for the next 18 odd months.
So sexual wellness is where the focus is. Take us through your current revenues. Where will you close this year?
So, I'm not in a position to disclose the exact revenue numbers, but we should be in early to mid double-digit revenue run rate. And this is coming, this blitz scaling has come with a fairly sustainable economic engine, and we should be CM2 profitable.
All right. And why don't you take us through your omni-channel go-to-market strategy? What's your offline presence like, and what's the revenue mix? What are you going to focus on?
So today, more than 80-85% of our revenue comes from digital channels.
Right.
But the goal is to create an omni-channel experience eventually, because if you look at the likes of a Lenskart or a First Cry or a Mamaearth, all of these big startups, consumer tech or health and wellness startups, have had to go offline, not only to reach out to a broader market, but also to create a touch and feel and trustworthy experience in a very high touch category, right? So we are working with a bunch of chemists, doctors, and pharmacies. and seeing how we can create an experience that is much more differentiated than the average pharmaceutical companies. In many ways, right, we're bridging together the entire supply chain. Chemist, doctor, and pharmaceutical company, all three is MojoCare for the end user. And how do we bring that experience online or to the nearby chemist store or to the nearby clinic? That's the end goal.
All right, so bridging that gap essentially. Now, affordability has been one of the biggest issues with regard to healthcare. How are you leveraging technology to make your services affordable and accessible, especially to tier 2 and 3 cities?
Yeah, absolutely. Tier 2, Tier 3 awareness and access has been a big problem, right? And because we do not have enough doctors in these spaces, not only are we creating a curated set of doctors who are trained by our medical experts, but we're also collecting a bunch of data across hundreds of thousands of our paid subscribers, as well as millions of our non-paid subscribers. And each one of these data points is going on to create a superior AI engine that will be able to identify symptoms, present diagnosis in an automated manner that can scale, right? So the care experience layer, adding doctors, is not really going to be linear. It's going to be fairly non-linear.
All right, Ashwin, thank you so much for joining us on the show, and we wish you all the best going forward.
Thanks, Shruti. Thanks, Arundhati.
On that note, it is time for us to slip into a quick break. But coming up next, we decode the early stage investor from firm Unicorn India Ventures' exit strategy. More details on the other side. Stay tuned. Welcome back. You're still with us on Startup Street. Unicorn India Ventures has identified 6 future winners from their Fund 1. As part of an agreement with Delaware-based Continuum Fund, Unicorn plans to sell its stake in the 6 future winners to the fund for 50 crore rupees. I'm now joined by Bhaskar Majumdar, the managing partner of the venture fund, to find out what is next for the venture firm. Hi, thank you so much for joining us on the show. You've invested in 17 startups through your first fund. You've entered into a strategic agreement with Delaware-based Continuum Fund to sell your stakes in 6 companies from Fund 1. So can you take us through the companies that you're selling stake in, and what was the rationale behind this decision?
Good to be again on the show, Arundhati. Yeah. So, when we started the fund, while investing and building businesses was one side of the business, for us, the holy grail of existence of the fund was to provide liquidity to the investors. And as you well know, this has been one of the concern areas for LPs in the Indian VC ecosystem. We already had provided a 1x, we had returned the capital back to the investors early in the year. And then thereon, we were looking at providing liquidity solutions for our investors. So within our portfolio mix, we had a bunch of 6 companies, all of whom had a very similar, breeding. All of them were profitable. All of them had recently raised their $5 to $10 million round. And all of these companies were the ones which had a huge runway left. Unfortunately, given the nature of the fund business, we had entered the 7th year of the fund, and therefore we had to look at liquidity solutions for our investors. And therein, we came in touch with the Delaware fund, run by very senior exited tech entrepreneurs. And after 6 odd months of discussion, going through the entire portfolio, we managed to provide liquidity to our existing investors through a continuum structure. I think this is a unique type of deal that we have done. And, this has been very well appreciated within the industry itself.
Absolutely. So looking to provide liquidity options for your investors. But that's not all. You've also exited Box.ai and FarmRack and saw partial exit in OpenBank. What's your exit strategy? Why did you exit these companies?
Each of them were very different. Box.ai, again, was a great company. They had a fantastic product. But unfortunately, as it happens, sometimes good products don't necessarily lead to good marketing and sales. So we wanted to find a good home for them in the sense they could be a part of a larger platform which could address the customer needs. And that's how we exited Box.ai to Netcore, which, as you well know, is India's largest Marcom company. PharmaRack, on the other hand, was a slightly different story. They had unique business model. They were digitizing the entire pharmaceutical industry supply chain. And when the whole industry in the whole pharmaceutical industry was being changed with the big boys like Reliance and others coming into play, we saw an opportunity in a new company, a new consortium which was formed by all the leading pharmaceutical companies like Torrent, like Sun Pharma, for them to acquire PharmaRack. So, these were two tactical opportunities that had come our way. Open Bank, again, was, we wanted to give a substantial liquidity position. We were the first investor in Open Bank, which, as you well know, is India's 100th unicorn. We had a substantial holding. At today's market value, the holding is around 75 odd million dollars, and we wanted to provide some liquidity. That's when we sold 20% of our stake in Open and provided liquidity to our investors.
Bhaskar, there are so many more questions I want to ask you, but we have to wrap up this interview because we have a breaking news coming in. So thank you so much for joining us on the show today.
Thank you.